It's over. The reserve requirement just changed. Your cash is leveraged now. For decades, you believed your money was sitting safely, waiting for you, untouched. But behind the scenes, one quiet policy shift just rewrote the rules of how your bank actually operates. No sirens, no breaking news banners, just a single adjustment that turns your deposits into fuel for the system. When the buffer shrinks, the pressure builds. And history shows what usually happens next isn't announced in advance. The real question isn't if this matters. It's whether people will notice before liquidity gets tight and the exits start to crowd. Welcome to Market Metal, where we slow things down, look at the facts calmly, and connect the dots that most headlines rush past. If you value clear, steady explanations, not hype, consider subscribing and turning on notifications. Think of this channel like a quiet briefing you can rely on, especially if you've spent years building and protecting what you've earned. And before we begin, tell me in the comments, where are you watching from today? I always read them, and it helps us see just how global this conversation has become. The quiet policy shift that changes the banking equation. Major financial disruptions rarely begin with loud headlines or dramatic events. They often start with small policy adjustments that seem technical, even boring, to the public. In most cases, these changes are discussed in quiet rooms, written in formal documents, and implemented without urgency in the media. Yet, over time, these quiet shifts reshape how money moves through the system. The recent change in reserve requirements belongs to that category. It is not a market crash. It is not a sudden panic. It is a structural adjustment that changes how banks manage deposits and how risk is distributed across the financial system. To understand why this matters, one must first understand the role of reserve requirements. In simple terms, reserve requirements are rules that tell banks how much cash they must keep available compared to the total amount of deposits they hold. For decades, large commercial banks were expected to keep a meaningful portion of deposits as liquid reserves. These reserves could exist as physical cash in vaults or as balances held with the central bank. The purpose was straightforward. If customers needed their money, the bank would have a buffer. That buffer did not eliminate risk, but it slowed the speed at which stress could spread through the system. The recent shift reduces that buffer. It does not eliminate it completely, but it makes it thinner. This may sound like a technical adjustment, yet the implications are larger than they appear. When reserves are reduced, a greater share of deposited money can be used for lending, investing, or other financial activity. From the bank's perspective, this increases efficiency. From a system perspective, it increases sensitivity to shocks. Banks operate under what is known as fractional reserve banking. This means they do not hold all deposited money in cash. Instead, they keep a fraction and lend out the rest. This system has existed for centuries and has helped economies grow by expanding credit. Businesses receive loans, consumers finance homes, and governments issue bonds. In stable periods, this structure works smoothly because most depositors do not withdraw their money at the same time. However, the stability of fractional reserve banking depends heavily on confidence. If depositors believe their money is safe, withdrawals remain predictable. If confidence weakens, withdrawals accelerate. When many depositors request funds at once, the bank must quickly find liquidity. That is where reserves play a critical role. They act as the first line of defense. By lowering reserve requirements, the system allows banks to operate with a smaller immediate cushion. The money that once sat idle can now be deployed into loans, securities, or other assets that generate returns. On paper, this improves profitability and supports economic activity. In practice, it also means that more deposits become part of the broader credit machine. The perception that money is simply stored in an account becomes less accurate. Instead, deposits function as raw material for financial leverage. This distinction is important for business owners and entrepreneurs who rely on predictable access to liquidity. Many assume that cash in a bank account is fully available at any moment. In normal conditions, that assumption holds true because daily withdrawals are balanced by incoming deposits. Yet the mechanical reality is different. Once funds enter the banking system, they are quickly allocated across multiple layers of lending and investment. The difference between interest rate policy and reserve policy is also worth noting. Interest rates determine the price of borrowing. They influence how expensive it is for businesses to finance expansion or for consumers to take loans. Reserve requirements, on the other hand, determine the structure of the system itself. They shape how much leverage can exist for each unit of deposited money. While rate changes attract public attention, structural liquidity rules quietly define how resilient the system is during stress. A reduction in reserves suggests that policymakers are prioritizing credit flow. When lending capacity expands, banks can support more borrowing without needing to cut interest rates aggressively. This can be useful in periods when economic growth is slowing, but inflation risks still exist. By freeing up balance sheet capacity, regulators attempt to maintain activity without sending strong signals through headline rate cuts. For decision makers, the key issue is not whether the change is good or bad in isolation. The more relevant question is what the timing reveals. Structural adjustments rarely occur randomly. They usually respond to pressures that are already building beneath the surface. When liquidity buffers are reduced, it often indicates that institutions expect higher demand for credit or anticipate tighter financial conditions ahead. This does not mean a crisis is guaranteed. Financial systems are complex and adaptive. Many safeguards still exist, including capital requirements, liquidity coverage rules, and central bank facilities designed to provide emergency funding. However, thinner reserves reduce the margin for error. In stable environments, the difference may not be visible. In volatile environments, it can determine how quickly stress spreads. Another important factor is how modern banking has evolved. Decades ago, bank balance sheets were simpler. Today, they include a wide range of securities, derivatives, and structured products. These instruments can be profitable, but they also introduce additional layers of risk. When reserves are lower, institutions rely more heavily on the assumption that markets remain liquid. If liquidity dries up, selling assets without losses becomes difficult. For entrepreneurs and business operators, this environment changes how liquidity should be viewed. Access to credit lines, the reliability of financing partners, and the stability of counterparties become more important than during easy money periods. Businesses that depend heavily on short-term funding are especially sensitive to shifts in bank balance sheet capacity. When banks tighten lending standards, even profitable companies can face cash flow pressure. The reserve requirement shift therefore acts as a signal rather than a headline event. It suggests that maintaining credit flow has become a priority. It also indicates that policymakers may be preparing the system to operate with higher leverage relative to immediate liquidity. Historically, such phases often occur late in credit cycles when debt levels are elevated and growth momentum is uneven. From a strategic standpoint, the most rational response is not fear but awareness. Understanding how deposits move through the system allows decision makers to plan with realistic assumptions. Cash management policies, diversification of banking relationships, and maintaining internal liquidity buffers become practical considerations rather than theoretical ones. Businesses that treat liquidity as a strategic asset tend to navigate uncertain periods more effectively. In summary, the reserve requirement shift represents a quiet but meaningful change in the architecture of modern banking. It does not announce a crisis, yet it alters how risk is distributed between institutions and depositors. By allowing more deposits to be used as leverage, the system increases its capacity to support credit while reducing its immediate shock absorption. For those who manage capital, employ teams, or plan long-term investments, recognizing this structural adjustment is essential. The rules of the game have not collapsed, but they have been subtly rewritten, and understanding those new rules is the first step toward operating safely within them. Debt saturation and the fragility of the credit system. If the first part explained how the structure of the banking system quietly changed, the second part focuses on something even more important, the environment in which that change is happening. Because in finance, timing is rarely accidental. Structural shifts usually appear when pressure is already building beneath the surface. Across the global economy, debt has expanded to levels never seen before in modern history. Governments have borrowed to sustain growth, corporations have borrowed to expand operations, and households have borrowed to maintain living standards. For more than a decade, this expansion seemed manageable because the cost of borrowing was extremely low. Interest rates remained near historic bottoms, and cheap credit became the fuel that kept the economic engine running. During those years, many institutions built strategies around the assumption that money would remain inexpensive. Companies issued long-term debt at very low rates. Governments financed deficits with minimal pressure. Consumers took on mortgages, auto loans, and credit lines that appeared affordable at the time. The system adapted to easy money, and leverage quietly became normal. But the environment has changed. When interest rates began to rise in response to inflation pressures, the cost of servicing that enormous debt pile increased sharply. What once looked sustainable started to look heavy. Corporations that previously refinanced at very low rates suddenly faced borrowing costs 2 or 3 times higher. Governments saw interest payments consume a larger share of their budgets. Households with variable rate obligations experienced rising monthly expenses. This shift created a slow but powerful feedback loop. As debt service costs increased, less money remained available for spending, hiring, and investment. Reduced spending weakened economic momentum. Slower growth increased the probability of defaults. Rising default risk forced lenders to become more cautious. And when lenders become cautious, credit availability contracts. This is how credit cycles tighten, not through one dramatic event, but through many small pressures accumulating at once. Banks sit at the center of this cycle. Their balance sheets hold loans, bonds, and other financial assets that depend on steady repayment. When the broader economy weakens, those assets become less reliable. Losses may not appear immediately, but stress begins to build in the background. Loan performance softens. Refinancing becomes harder. margins shrink. In this kind of environment, central banks face a difficult dilemma. Lowering interest rates aggressively could stimulate borrowing and relieve pressure, but doing so too quickly risks reigniting inflation. Keeping rates elevated helps control prices, but increases strain on borrowers and lenders. This is the classic conflict between price stability and financial stability. When direct rate cuts become politically or economically constrained, policymakers often turn to quieter tools. Adjusting reserve requirements is one of those tools. By allowing banks to hold less in immediate reserves, more capital becomes available for lending without changing headline interest rates. On the surface, this appears supportive for growth. Beneath the surface, it signals that maintaining credit flow has become a priority. The reason this matters is simple. Credit is the lifeblood of modern economies. Businesses depend on financing to manage cash flow, purchase equipment, and expand operations. Real estate markets rely on mortgage availability. Supply chains function on short-term credit lines. When credit tightens, the effects spread quickly across industries. Entrepreneurs often feel this shift before it appears in official data. Banks begin asking for more collateral. Loan approvals take longer. Terms become stricter. Even companies with solid performance records may find that access to capital is no longer guaranteed. The cost of uncertainty rises. At the same time, high debt levels amplify sensitivity to small economic shocks. When leverage is modest, systems can absorb setbacks. When leverage is extreme, even minor disruptions can trigger larger reactions. A decline in revenue, a drop in asset values, or a temporary liquidity shortage can cascade through balance sheets that are already stretched. This is why the reserve requirement shift carries deeper meaning than a technical adjustment. It arrives during a period when the global economy is already carrying significant financial weight. Instead of strengthening buffers, the system is allowing institutions to operate with thinner immediate liquidity. That choice suggests confidence in continued stability, or recognition that maintaining credit flow is more urgent than preserving maximum safety margins. Another layer of pressure comes from refinancing cycles. Large amounts of corporate and commercial debt were issued during years of low rates. As those obligations mature, they must be rolled over at current market conditions. If new borrowing costs are significantly higher, many borrowers face difficult decisions. Some reduce investment, others cut expenses. A few may default. Each of these outcomes feeds back into the banking system. Reduced investment slows growth, expense cuts affect employment, defaults create direct losses. Over time, this environment encourages lenders to protect their balance sheets by tightening standards further, reinforcing the cycle. The situation becomes even more sensitive when financial markets grow dependent on continuous liquidity. Modern markets move quickly, and asset prices react instantly to changes in expectations. When liquidity is abundant, price swings are manageable. When liquidity tightens, volatility increases. Institutions holding leveraged positions become vulnerable to rapid repricing. In such conditions, policymakers often attempt to maintain stability by ensuring that credit channels remain open. Lower reserve requirements can support this objective by increasing the amount of funds banks can deploy. However, this support comes with a trade-off. The system gains short-term flexibility but loses part of its shock absorption capacity. For business leaders, this environment demands a different mindset. Growth strategies built entirely on cheap leverage become riskier. Access to capital can no longer be assumed. Liquidity planning moves from a secondary concern to a central priority. Companies that maintain strong balance sheets, manageable debt, and reliable cash flow tend to navigate tightening cycles more successfully than those dependent on constant refinancing. The broader lesson is that financial systems rarely fail because of a single decision. They become fragile when multiple pressures align: high debt, rising costs, slowing growth, and reduced buffers. The recent reserve requirement adjustment should be viewed within that larger context. It is not an isolated move. It is one piece of a broader effort to keep credit moving through an economy that is carrying unprecedented leverage. From the outside, daily life may appear unchanged. Consumers continue spending, markets continue trading, businesses continue operating. Yet beneath that surface, the structure supporting those activities is becoming more sensitive to disruption. The difference between stability and stress often lies not in visible events, but in the resilience of the system behind them. As this cycle progresses, the key variable will not simply be interest rates or market headlines. It will be confidence. Confidence among lenders, borrowers, investors, and depositors. When confidence is strong, leverage can remain hidden without consequence. When confidence weakens, the same leverage becomes a source of rapid instability. That is why the timing of structural policy shifts matters so much. They reveal what institutions are preparing for, even when public messaging remains calm. The credit system has not stopped functioning, but it is operating under increasing pressure. And when pressure builds inside a highly leveraged environment, the next phase of the cycle is rarely determined by optimism alone. Banking system stress, signals beneath the surface, By the time structural policies begin to shift, the visible problems have usually already appeared somewhere in the system. They may not dominate the headlines anymore, but the signals remain. In modern finance, instability rarely arrives without warning. It leaves a trail, subtle at first, then increasingly difficult to ignore. The current environment shows several of those signals, and together they form a pattern that serious observers tend to watch closely. One of the most important indicators is how banks manage the relationship between their assets and their liabilities. On paper, a bank's balance sheet may appear stable. Deposits sit on one side as liabilities, while loans, bonds, and securities sit on the other as assets. In calm periods, the value of those assets is assumed to be reliable. But that assumption depends on market conditions remaining supportive. When interest rates rise or economic growth slows, the value of many financial assets begins to change. In recent years, many institutions accumulated long-duration securities during periods when yields were extremely low. These instruments offered steady returns at the time, but they also carried sensitivity to interest rate movements. When rates moved higher, the market value of those holdings declined. The losses were often categorized as unrealized, meaning they were not immediately recognized unless the assets were sold. However, the economic reality remained. The assets were worth less than their original book value. This distinction between accounting stability and economic reality is critical. A bank can appear solvent on paper while facing hidden pressure beneath the surface. As long as depositors remain confident and withdrawals remain normal, the system continues to function. But if confidence weakens and liquidity is required quickly, institutions may be forced to sell assets at unfavorable prices. Those losses then become real, not theoretical. Another area of concern is the concentration of risk in certain sectors, particularly commercial real estate. Office buildings, retail centers, and mixed-use properties have faced changing demand patterns. Remote work trends, shifting consumer behavior, and higher financing costs have all influenced valuations. When property values decline, the loans tied to those assets become more vulnerable. Banks holding large portfolios of such loans must either absorb losses or renegotiate terms with borrowers. Regional institutions are especially sensitive to this dynamic because many of them hold a significant share of these loans. Unlike larger global banks, they often have less diversified revenue streams. If defaults increase in one segment, the impact can spread quickly across their balance sheets. The pressure may not cause immediate failure, but it reduces flexibility. Lending standards tighten. New credit becomes harder to obtain. Economic activity slows further. At the same time, emergency liquidity facilities introduced during previous periods of stress continue to exist in various forms. These programs were designed to provide temporary support, allowing banks to borrow against their assets without selling them during volatile market conditions. The fact that such facilities remain active or extended suggests that underlying stress has not fully disappeared. Institutions still rely on backstop mechanisms to maintain smooth operations. This reliance is not unusual in modern financial systems, but it does indicate sensitivity. When markets function normally, banks prefer to fund themselves through deposits and standard financing channels. Dependence on emergency-style support implies that parts of the system remain cautious about liquidity conditions. It is less a sign of immediate crisis and more a sign that resilience is not as strong as headline indicators might suggest. Another signal often observed is the behavior of bank equity prices and credit spreads. When investors perceive increased risk, they demand higher returns to hold bank-related securities. This can show up as underperformance relative to broader markets or widening spreads in debt instruments. These movements do not always predict failure, but they reflect shifting expectations about profitability and stability. What makes the current situation more complex is the interconnected nature of modern finance. Banks are linked through lending markets, derivative exposures, payment systems, and shared asset holdings. A loss in one area rarely remains isolated. If a group of institutions experiences stress simultaneously, confidence across the network can weaken. In highly leveraged systems, confidence acts as the primary stabilizing force. Once it begins to erode, reactions can accelerate. Lower reserve buffers amplify this sensitivity. With thinner immediate liquidity, institutions depend more heavily on market functioning and external funding sources. If those sources become strained, the margin for adjustment narrows. Even healthy banks may adopt defensive behavior, reducing lending, increasing collateral requirements, or prioritizing cash preservation. These defensive moves, while rational individually, can collectively slow economic momentum. The transmission mechanism of systemic stress often follows a predictable path. First, asset values decline in a specific sector. Second, institutions holding those assets report weaker earnings or capital ratios. Third, lenders tighten conditions to protect their balance sheets. Fourth, businesses and consumers experience reduced access to credit. Finally, the slowdown feeds back into asset performance, reinforcing the cycle. Confidence sits at the center of this chain. In fractional reserve systems, deposits are largely stable because most people trust that funds are available when needed. If that trust remains intact, even significant losses can be managed over time. If trust weakens, liquidity demands rise rapidly. Institutions must then convert long-term assets into short-term cash, often at unfavorable prices. This dynamic has repeated throughout financial history. Technology has accelerated the speed at which such shifts can occur. Digital banking allows funds to move instantly. Information, accurate or otherwise, spreads across networks within minutes. What once took weeks can now unfold in hours. This does not guarantee instability, but it reduces the time available for institutions to respond. For entrepreneurs and business operators, these signals translate into practical considerations. Counterparty risk becomes more relevant. The reliability of credit lines, payment processors, and financing partners deserves closer attention. Companies that maintain diversified banking relationships and clear visibility into their cash positions tend to manage uncertainty more effectively. Those dependent on a single source of funding may find themselves exposed if conditions tighten unexpectedly. The broader point is not that failure is imminent. Financial systems are designed with multiple layers of support, including regulatory oversight and central bank intervention tools. However, the combination of high leverage, asset sensitivity, sector-specific stress, and thinner liquidity buffers creates an environment where shocks can travel faster than before. In such environments, the absence of visible panic can be misleading. Stability during calm periods does not always reflect true resilience. Often, it reflects the presence of confidence in external support mechanisms. The real test appears when conditions shift and institutions must rely on their own balance sheets. As reserve requirements decline, the system becomes more efficient but also more dependent on continuous liquidity. That trade-off may support short-term credit flow, yet it increases reliance on stable market conditions. When multiple stress signals appear simultaneously, asset repricing, sector weaknesses, reliance on funding facilities, the prudent approach is careful observation rather than complacency. The banking system is not broken. It continues to function, process payments, and extend credit. But beneath that functionality, pressure points are visible to those who examine balance sheets rather than headlines. In highly interconnected financial structures, early signals rarely announce themselves loudly. They appear as small inconsistencies, temporary facilities that persist longer than expected, and cautious behavior from institutions that understand their own exposure. These signals do not guarantee a crisis. They do, however, indicate that resilience is being tested. And in a system operating with thinner reserves, the difference between routine volatility and systemic stress can depend less on the size of the initial shock and more on how quickly confidence begins to shift. Historical lessons and strategic positioning in a thinner buffer system. Financial systems rarely move in straight lines. They expand, become confident, increase leverage, and then, often quietly, reduce the very safeguards that were created after the last crisis. This pattern has repeated across generations. The present moment fits within that long historical rhythm, where efficiency is prioritized while resilience is slowly trimmed. Looking back, one consistent lesson appears again and again. Liquidity buffers matter most when they seem least necessary. During periods of stability, holding extra reserves feels inefficient. Capital that sits idle does not generate returns. Institutions, under pressure to improve profitability, gradually search for ways to deploy more of their balance sheet into productive assets. Over time, this collective behavior reduces system-wide shock absorption. In the early 20th century, many banks operated with limited liquidity protection. When economic conditions deteriorated, depositors lost confidence and attempted to withdraw funds simultaneously. The institutions were not always insolvent in the long term, but they lacked the immediate cash required to meet sudden demand. The result was a cascade of failures that forced policymakers to introduce stronger safeguards, including standardized reserve practices and deposit insurance frameworks designed to restore trust. Decades later, similar dynamics appeared in different forms. During periods of strong growth, financial institutions expanded lending and invested in long-duration assets that promised steady returns. When interest rates shifted or asset values declined, those positions became vulnerable. Losses did not always appear overnight, but they accumulated quietly until confidence weakened. Each cycle ended with the same conclusion. Buffers that seemed unnecessary during prosperity proved essential during stress. What makes the current environment distinct is the complexity and speed of modern markets. Financial instruments are more sophisticated, balance sheets are layered, and capital moves across borders instantly. A localized problem can now travel through interconnected systems faster than in previous decades. Efficiency has improved, but so has the potential for rapid transmission of shocks. Lower reserve requirements should therefore be understood within this broader historical pattern. They represent a decision to favor credit flow and economic activity in the present, while accepting a smaller margin for unexpected disruption. This is not inherently reckless. Policymakers often make such trade-offs to prevent stagnation. However, the trade-off changes how institutions and businesses must think about risk. Another recurring lesson from history is that leverage cycles tend to peak when confidence is strongest. During expansion phases, rising asset prices and stable conditions create the impression that risks are manageable. Institutions become comfortable operating with thinner cushions, because recent experience suggests that severe stress is unlikely. Yet the very absence of visible danger can encourage behavior that increases vulnerability. In highly leveraged systems, the trigger for instability is rarely dramatic on its own. It may begin with a modest decline in asset values, a temporary liquidity shortage, or a shift in market sentiment. What turns a manageable event into a systemic problem is the structure surrounding it. If buffers are thin and interconnections are dense, reactions can amplify quickly. Confidence, once shaken, is difficult to restore without external support. Modern financial architecture also introduces another layer of sensitivity: opacity. Many risks today are embedded within complex instruments that are not easily understood outside specialized circles. This complexity can delay recognition of problems. By the time losses become visible, institutions may already be adjusting defensively, tightening lending, preserving cash, and reducing exposure. These defensive actions, though rational individually, can collectively slow economic momentum. For business leaders and entrepreneurs, the strategic implication is clear. Periods of structural adjustment are not primarily about predicting crises. They are about managing optionality. Optionality means maintaining the ability to act even if conditions change unexpectedly. Companies that preserve liquidity, avoid excessive leverage, and diversify funding relationships retain flexibility when others are forced into reactive decisions. One practical principle that has proven resilient across cycles is prioritizing liquidity over marginal yield. During expansion phases, the temptation to chase higher returns is strong. Idle cash appears inefficient. Yet, when credit conditions tighten, access to immediate funds becomes a competitive advantage. Firms that can operate without relying on emergency financing often navigate downturns with less disruption. Diversification also takes on broader meaning in such environments. It is not limited to asset classes, but extends to institutional relationships and operational structures. Relying on a single lender, a single funding channel, or a single jurisdiction concentrates risk. Spreading exposure across multiple counterparties reduces the impact of localized stress. Redundancy, which may seem unnecessary in calm periods, becomes valuable when systems are tested. Another strategic consideration involves the duration of financial commitments. Long-term obligations with fixed terms can become restrictive if economic conditions shift. Shorter duration structures, flexible financing, and adaptive cost bases provide room to respond as circumstances evolve. This does not eliminate risk, but it prevents organizations from being locked into unfavorable positions. History also shows that resilience is rarely built during a crisis. It is built before one. Institutions that enter uncertain periods with strong balance sheets and conservative assumptions tend to survive even severe disruptions. Those operating near their limits often depend on external intervention. While central banks and governments possess tools to stabilize markets, reliance on those tools introduces uncertainty because political and fiscal constraints change over time. The present policy environment suggests that maintaining credit flow has become a priority, even if it requires operating with thinner immediate reserves. This approach can support growth in the short term, but it places greater importance on confidence and continuous liquidity. If those conditions remain stable, the system functions efficiently. If they weaken, adjustments can occur rapidly. For decision makers, the objective is not to withdraw from the system, but to engage with it realistically. Understanding how deposits, credit, and leverage interact allows for better planning. Cash management policies, diversified financing sources, and disciplined capital allocation become strategic tools rather than administrative details. Organizations that treat liquidity as a core asset rather than an afterthought tend to preserve control over their options. The broader narrative is not one of imminent collapse, but of shifting risk distribution. When buffers shrink, responsibility for resilience moves outward, from centralized safeguards toward individual institutions and businesses. Each participant must evaluate exposure, maintain flexibility, and prepare for a range of outcomes rather than assuming stability will persist indefinitely. In every major financial cycle, the turning point is recognized clearly only in hindsight. During the moment itself, conditions often appear manageable. Markets continue operating, transactions proceed, and daily activity feels normal. The difference lies beneath the surface in balance sheets and liquidity structures that determine how the system responds when pressure increases. The current reserve requirement shift represents such a structural change. It does not end the cycle, but it alters the terrain on which the next phase will unfold. For those responsible for capital, employment, and long-term planning, the most prudent response is neither alarm nor complacency. It is disciplined awareness, recognizing that efficiency has increased, cushions have narrowed, and resilience now depends more heavily on preparation at the institutional level. In environments where margins for error become thinner, the advantage belongs to those who remain flexible, liquid, and strategically diversified. History has shown repeatedly that systems built on confidence can function for long periods without visible strain. Yet when confidence is tested, outcomes are shaped less by optimism and more by the strength of the buffers that remain.